Hey guys, Taylor with GammaEdge here coming at you with a post-market recap for April 7th, 2025. TLDR today is, massively put dominant environment in which huge intraday ranges continue that we saw on Friday. You can see the chart here. I have, whole levels marked out, that meaning 5,000, 5,100, 5,200. You can see we operated within like 150 point range today. So quite volatile. But before getting into the specific trade today, let's go in over the pre-market prep real quick. So pre-market or end of day Friday, this is what the market trend model looks like. If you're not familiar with the market trend model, it's based off the tick index. You can Investopedia that if you're not familiar with that. But essentially, that is a gauge of real-time buying versus selling in the market. Upticks, the tick index goes up, down ticks, and the tick index goes down. So pretty simple. Thing about the tick index is it resets daily. So what we do is we create a time series of that day over day, which is what we call the cumulative tick. It's this bolded white line. Therefore, we're able to understand not only the intraday trend, but multi-day to multi-week trends as well. And this benefits both, intraday SPX futures traders as well as swing traders. And so on Friday, we saw this roll over, a decisively down, linear down day is what we call it. We also create something called the filter tick, which is this bold cyan line. Filter tick is any time that the tick index registers a reading of plus or minus 1,000, which is a general benchmark accepted by the market as a whole of being significant buying or selling. That is when this line will either move up or down. So Thursday, we saw a little bit of selling come in, and then Friday, we saw progressive selling all session long. So, based off of our market turning framework that we've been talking about, and I will hit on again tonight for you guys, if you haven't heard it before, we've been in a put dominant environment, and now the market trend model that has started to roll over again. So coming into the session today, there was really nothing to be bullish on from a multi-day to multi-week point of view. So, if you're a swing trader, long-term capital allocator, not a ton to do right now in this environment in terms of putting your capital to work, because you would seriously be going against the trend right now. And at least from our point of view in our system, nothing right now is saying that you should be long or you should be aggressively getting long. There will come a point in time where the market starts to thaw, market trend model trends higher, calls start to come back in the complex, but that is not right now. So with that said, here's the SPX complex. And by complex, we mean the options market. Why the SPX? We start with the SPX because that's the largest, most liquid options market. And by definition, options are forward-looking and more speculators are positioning within the options market. So this is a great way of understanding future expectations of the market. And if you didn't know, there's two components of the SPX. There's SPXA and SPXP. We always start with SPXA because that is much larger than SPXP, but it's also longer term, slower moving, institutional type capital. So you can think of the SPXA as a cruise ship, and then SPXP as more of a cigarette boat, because SPXP contains your dailies, that contains your weekly expirations, your 0DT expirations. So while it is a smaller market, it is still very large on a notional basis, and that capital recycles, turns over a lot faster. So going back to the SPXA, which is what we have here, this is your monthly, your quarterly expirations. Here we can see we are just nothing but in a put dominant environment. And, we're just showing here the implied open, which was like 59.35, which was, over 100 point gap down from Friday's close. So we are just even in a more put dominant environment with that open. Just so you know what the opposite inverse looks like, here is a prior example of what a call dominant environment in the SPX looks like, right? Nothing but green, call dominated. Reason that's important is because it's our belief at GammaEdge that markets are driven by out of the money call and put speculation. We see that sine wave occur over and over and over. And when we have a bullish foundation in which we expect price appreciation higher, the bullish foundation is A, the market trend model is progressing higher with institutional buying. B, you have a call dominated environment. Going back to where we are today, definitely not the environment. So if you're a swing trader, again, trying to get long, this is not the time to do it. Hopefully that is clear. Moving on to SPXP. Again, put dominated environment, gapping down. It's the same gap down we just talked about, over 100 points. Down below, even to a more put dominated structure. So again, right, as a swing trader or whoever, you needed 5 seconds to know that the overall structure of the market was super pessimistic. Yes, we understand everyone comes into the market every day. You put in the work to do your preparation, and it's sometimes deflating to recognize that, dang, I may not trade today because the environment is crap. But that is part of trading and understanding when to be putting capital work and when not to be putting capital work, waiting for your pitch. That's what makes, subpar bad traders versus good and great traders. And if you're not comfortable sitting on your hands for an extended period of time waiting for that fat pitch, then there's likely going to come a day where the market is going to turn its lights on, but you are not able to. So you don't have to follow the GammaEdge system, but you need to have some way in your system to alert you of the market environment that you're in and if that is conducive or not conducive to your trading strategy. Before moving on to 0DT, just a couple other sentiment tools that we like to use here at GammaEdge, which is again helpful for the swing traders out there. One called the GEX ratio. GEX ratio, simply put, is total call gamma relative to total put gamma in the options complex. We use it again for SPXP for all the reasons, or SPX for all the reasons I just talked about earlier. And another way to think about the GEX ratio is it's like the put call ratio, but it is superior because we are incorporating time into the ratio, which the put call ratio does not. For example, if you open 1 million puts 2 years from now, that's going to significantly spike the put call ratio. Twitter's going to go crazy. But in reality, at least from a trader's point of view, that really does not have any impact in the short-term structure. So in terms of gamma, that's really not going to do anything to this ratio. So hopefully that differentiates or describes the differences in the GEX ratio versus put call ratio and why you may be interested in using the GEX ratio. And yes, I understand right now this was super choppy. But that in of itself is a signal because price action was also choppy as well. In sustained periods of uptrends, we see this GEX ratio trending higher, oftentimes leading price, because that is suggesting that calls are coming into the complex relative to puts coming into the complex. And so right now we can see the GEX ratio is basically bumping along the bottom at its lows. So that really indicates that there is no call speculation coming in the complex, and being below 1, that tells us that puts are in control. And then again, another indicator that we like to use, or it's a tool, it's not an indicator, is what we call the true zeros. What these are proprietary calculations to GammaEdge. They're spot price invariant, meaning that spot price does not impact the calculation. And what these calculations do is they find the true center point in the structure of both the calls and the calls and the puts in the context of delta and gamma. And so again, what we want to understand here is we want to understand where that center point for call and put gamma is moving. And again, it's been trending lower since the middle of February. You can see in these periods. Now, granted, this entire time series I have here, which is back in the last 150 days, and it's been either chop or sideways. We can see that there is, small pockets of upward price progression. That's where we see this ratio trend higher. But again, sideways, it's been nothing but trending lower. And again, the current condition right now is trending lower. So until we can see this, these data points start to trend higher again, which again tells us that calls are coming back to the complex. From a swing trading point of view, the environment is not good. So you can understand market trend model, looking at the SPX dashboards themselves, or the GEX ratio, their true zeros. Those are 4 quick, easy tools you can look at, which tell you if calls or puts are in control. That control is getting bigger or smaller, and everything is suggestive that it's a put dominant environment, and it's really crummy for swing traders right now. So after all that, then we can get into SPX 0DTE. Because, understanding the context of swing trading, it's not good. There may be still opportunities on an intraday basis that we could take advantage of. Having said that, we're in a massively put dominant environment. We're gapping down over 100 points from where the center of the structure is on the SPX 0DT. So we are in a massively put dominant environment. We talked about it last night on open mic, but when we get this far extended from the center of the structure, where the transitions are. By transitions, I mean our key transition zones that we typically talk about, but they're not relevant right now because we're so far away from those. That price action gets very disorderly as opposed to orderly, where we see price action, contained or respecting those transition levels. But instead, massive put dominant environment, that's where we have these massive volatile ranges. And that is where where really all we can do is leverage our intraday volume analysis to hopefully give us a clue on what the call and the put speculators are doing intraday. And so just hitting on something from the pre-market prep we told the community this morning, like we weren't going to provide guidance on if-thens within the key strikes. If-thens, if you don't know, are if this, then that. So typically for GammaEdge, that point of view, that's, if we break through this key level, then we expected this to happen. And so, yes, we just say our edge right now is unknown, so we're not going to make crap up. And if that makes you sad that we don't know everything all the time and admit when we just don't know, our edge just isn't there, then GammaEdge probably isn't the place for you. But we are candid and transparent with what we were thinking. So again, ending it today, just want to go back to recapping price action real quick. Again, all I have is just these key hold levels because the market likes hold levels, and when it has a range of 150 points and 5-minute candles that are 50 points wide, those whole round levels sometimes can be kind of key intraday points in the market. And then again, for those folks that like technical analysis type stuff, this white line here is VWAP. VWAP was flat on the day, just corresponding with the chop that we saw kind of oscillate around 5,000. And then showing what the market trade model did intraday today, we saw a continuation lower on the session. Pretty good linear down day to start the session, and that rate of change ease up. Ultimately, we still closed lower on the day from where we finished Friday. So net, again, not a great sign for the bulls. And then we did see, then from a filter tick point of view, today we did see a little bit of net selling. Granted, was not at the same magnitude that we saw on Friday, but net, it was still selling on the day. And then market breadth, you had 83 stocks making new highs. You had 4,000 making new lows. So again, just another sentiment indicator that structure is pretty crummy right now. And then leveraging our intraday volume analysis, which for those that are not familiar with this, what we do is on 5-minute basis throughout the sessions, we take the SPX 0DT call and put volume. For the call side, we aggregate the distribution. We find the middle point of that distribution, we plot it. That's called the centroid. And so every 5 minutes, we are plotting the centroid. We connect the dots. So at any point in time from the open to that point in time, we can understand the behavior and the sentiment of the call speculators in this example. And from those data points, we can forecast out what the likely path of price is, assuming all things equal, meaning if call speculators were speculating in this manner, then all things equal, we can expect that manner to continue. And if that does not continue, then we will see it in the centroids, either rolling, water falling over to the downside, maybe we get some massive put speculation to the upside. So we see it, continually trend to the upside. You can see today that was not the case. Just look at the width of the distribution between the call and put sides. Generally, this is pretty tight. Today was not so much. I think I'll show you guys, but at 3 o'clock, I think the width between the lines of best fit was like 200 points. Typically in the last hour of the session, it's like 20 to 30 points. So again, that just shows you the heightened volatility that we saw in the markets today. And again, just looking at the call and the put side right now, like there was no massive impulses higher or lower. Yes, the put side was, a gradual easing higher, which is better than seeing a waterfall lower on the day. But really, there was nothing spectacular happening on the call side. So again, just with this in mind, like it was easy from an intraday trader's point of view to sit this session out because again, for us, there is no edge to be had. Now, if you're a credit seller, credits spread trader or something like that, obviously, selling spreads on, the top or the bottom or whatever you want to do there against key levels could have been an avenue that you took today. But again, the volatility was huge. And so, yeah, there just wasn't a ton to be had in our opinion. And here, just showing you an example of the utility of the market trend or of the volume command, intraday volume analysis. This was at, approximately 130. You can see obviously the call centroids, the put centroids, the lines of best fit, which means, from the call side point of view, we take all of these centroids, we understand, kind of just, a simple linear regression of what has happened, what we can expect to continue, all things equal. Same thing for the put side. And you can see here, the distribution of the final endpoints was like 200 points wide, which is massive. So again, just another context clue of the massive volatility in the markets that we saw today. But this is helpful in the context that we were expecting a choppy price action throughout the end of the close, right? So at 130, we knew price action, all things equal, was going to remain choppy and also stay within the context of these bands unless something else happened. I think we finished the day like at 50, 70. So it pretty much finished right in the middle of this distribution, which was useful. So again, you know, your credit spread trader, sorry, I can't say that tonight. And you know, you recognize that we're gonna have, you know, choppy price actions depending on the premium that you could get. Perhaps you could have taken advantage of something. So with that's all we got for you guys tonight. Hopefully, you know, from a swing trading point of view, or even kind of our market trending framework, using the market trend model, evaluating the SPX dashboards to understand call put speculator sentiment, and then using our intraday volume tools, hopefully you got some value out of something that, you know, you honestly could incorporate in your trading as soon as tomorrow. So with that, you guys have a great night, and we'll see you all tomorrow on the pre-market. Thanks. Bye.